look like the favor is back in the Indian market. But it is here for sure or no. Let's bring on board our guest for today. We have Sunil Subramaniam as well as we have Naresh Mirani joining us on the show. Naresh, firstly, let me come to you. Get a chart check on the markets, the way how actually we have actually rebounded and we're sustaining this rebound over the last 2 to 3 trading sessions. How sustainable is this?
So it's been stronger than what one would have expected after 3 days of a session, and today also we are seeing good momentum. So for now, 23,800 remains the most critical price point because that is the recent swing high. And 22,800, 23,000, which is where the earlier supports were, which got taken out on the downside. So we could be forming a range at a higher base now instead of that 22,000 to 23,000. So for now, dips to 22,800, 23,000 should see buying support, 23,800 should be a resistance. But the strength is strong across the broader markets as well.
Going there, Sunil, hi, afternoon. What is it that you're making of this steady climb that the markets have seen? The Nifty alone has recovered about what, almost 1,000 to 1,200 points from the recent lows?
I think it's, though FIs are coming back slowly, I still think it's the DII action which is driving the markets. Because as I had mentioned in my earlier interactions, there's a huge pileup of cash, almost about 2.5 lakh crores with DIIs there. And that money is a broad market money. It's not just large caps, it's large, mid and small. And what's happening is that as the fund houses had generated cash by selling small and mid cap stocks, used part of it to buy large caps, and hence the fall in large caps are not so much. They are essentially now will look at reversing the trade, right? In terms of as the FIs come in, they will try and sell the large caps which have rallied a lot in that period back to the FIs and redivert it into mid and small. The only proviso is still going to be very stock specific and not even a broad sector call, because I think the earnings season only will give you a real clarity on the expected EPS growth for next year. So I would say that wherever there is a value there in terms of a sharp correction with not too much damage expected on the EPS, fund manager will stepping in to buy. Again, international related sectors would still be a little bit on the edge because April 1st, how the reciprocal tariffs works and all of that. But overall, a host of positive news around India related. And I think some of it you mentioned just now, which is a weakening dollar, an expected two interest rate cuts this year, and probably a stability in the oil prices, and Indian valuations relatively have corrected quite well. So they are no longer very overvalued. They are around the long-term average now. So I think from an FI perspective, right, money will start flowing into emerging markets and India will claim its rightful share, but they will still be slow because they will still wait for the tariffs uncertainty and they will also wait for the Indian earnings season uncertainty. But domestic fund managers will quickly step in to fill the breach. And if you see the IT rally which happened before the correction was actually driven by domestic fund managers buying that in anticipation. Now the IT rally is softening broadly because there is no longer a weaker rupee in the play. And today's currency movement also bears that. So that's one big positive for the IT which was there earlier. Second is if the US is in a slowdown, buying of IT will naturally not be at those levels expected before. So to some extent, IT is a space where DMFs are booking profits and they will divert that into other pockets there, right? FII real action, I think, will start somewhere around the month of April.
Right. Coming back to you, Sunil, you did speak that it is, you can't go all out in the market at this point in time, but you have a lot of select companies and select pockets that are looking very attractive. The sectors are looking attractive. A lot of them are trying to make a comeback as well. Case in point being real estate in the last 2 to 3 weeks or last 1 week or so, that one is playing a catch-up trade when you actually look at it. It's been beaten down. It once upon a time used to be the talked about sector. What's your take now? Do you think realty merits a look?
I think it does merit a look for two reasons. One is you mentioned there was a sharp correction. But the second aspect is that there's a rate sensitive. And I think with the US leading with rate cuts, right, the differential between the Indian interest rate, GSEC, and the thing is going to get widened. Now, RBI, unless RBI follows with the rate cut, the currency is going to feel the pressure. So I believe that this helps the fact that RBI's rate cut will happen, and any rate cut with the liquidity infusion that RBI has very sensibly done means that transmission of rates down into EMIs should happen faster in the coming months. And so that's naturally a strong positive for real estate buying. So I think that's good. I think any rate sensitive sectors, I think are good picks broadly at this time.
Interesting. Bain Capital and Manappuram, they are the ones which are the newsmakers this morning, or rather since morning, I should say. And Bain Capital is now in a definitive agreement to acquire joint control in Manappuram Finance. They're going to be investing about 4385 crore rupees, which equates to about an 18% stake via preferential allotment of equity and warrants. Varun joins in with more details on what this really means for Manappuram Finance.
Finally, it's Bain Capital who will be acquiring the joint control of Manappuram Finance, and this would be for the next phase of growth for Manappuram Finance. Bain Capital would be acquiring 18% stake for rupees 4,385 crores, and this would be done through preferential allotment of equities and warrants, and the price is around 236 rupees per share, which is, if you look at the last 6 months price, it is 30% premium. If you look at around the current market price, the yesterday's close, it is around 8 to 8.5% premium to the current market price. Now the transaction will actually trigger an open offer of 26%, and the open offer price is also 236 rupees. And after the open offer, Bain Capital's stake in the entity would increase. It would be around 18 to 41.7%. The existing promoters, who actually hold around 30.3%, they will be holding around 28.9% in this entity, and the public shareholders would be holding around 29.4 to 53.1% in the in the new entity. Bain Capital, the overall board of the company would be reconstituted, and Bain Capital would this would include 2 nominee directors from Bain Capital. The transaction is expected to complete by Q2 or Q3 of next financial year. The existing promoters will continue to stay invested in the company. Mr. Nandakumar would be stepping into a non-executive chairman and mentor role, and Street sees this as a good positive, because the company would be getting growth capital, and also there were concerns regarding succession planning, so that overhang is also now behind for the stock. Street expects the valuation gap between Muthoot and Manappuram, which was more than 50%, now will come down drastically after Bain Capital gaining control of this company. Also, other than Bain Capital gaining control, Ashirwad Microfinance, which was supposed to come out with an IPO, they have actually withdrawn their DRHP because of uncertainty in the markets. So there are 2 news: one, Bain Capital acquiring stake, which is seen positive by the market, and also Ashirwad Microfinance, who have withdrawn their DRHP.
Right, thank you so much for that, Varun. And Muthoot Finance, sorry, I beg your pardon, Manappuram Finance and Muthoot Finance, both of these counters are also in focus, not just on back of this. Earlier this week, you had Muthoot Finance that was in focus on back of the way how their AUM was going and how they were growing their business. And now you have Manappuram Finance on back of this particular deal. Coming to you on the charts, actually, Naresh, how are you looking at both of these counters? Because also, let's not forget that gold also is a huge factor for both of these counters, given the fact that they are gold loan financiers. How do you see both of them?
So if we look at the last few years, very clearly Muthoot Finance has been a leader. Say from pre-COVID times, they both used to be very similar in terms of returns going forward. From 800,000 rupees, it has gone to 2,300 rupees. And if you look at Manappuram, the stock used to be, say, closer to 180, 200 pre-COVID, and was struggling for the last 4-5 years. Today, we've seen a final breakout of all those levels into new all-time highs. So going forward, I would expect Manappuram to become a buy on dips and a good, interesting opportunity, and relatively outperform Muthoot going forward.
That on the gold financiers, of course, it's Manappuram after that Bain deal. That's the one which is soaring new heights. We'll take a very quick break, come right back. We'll continue tracking markets on the other side.
Welcome back. You're watching Closing Trades right here on ET Now. We have moved a tad bit lower from those elevated levels. Nevertheless, a healthy day of gains coming in for the markets. And what will be very key thing to note or remember is the fact that we've seen the stock recovery also across sectors, especially Nifty IT index started the day on a very weak footing, but from there on we did manage to actually come back into the positive territory and hold on to those levels. So IT index definitely one of the star performers. And Sunil, do you think this one will be the star performer going ahead, or do you think it's you are going to lay all your bets only on the banking space?
The banking plus consumer discretionary.
Okay.
Basically, from an interest rate cut, I think the Fed soft dovish policy, the US kind of sending into a recession, a Trump session as they call it, plus the inflation trending down in India, and our growth yet to really get into rocket space, means the conditions are ideal for a RBI rate cut plus a rate transmission due to liquidity infusion by RBI. So I think the rate sensitives are my play, and naturally BFSI space is there, and consumer discretionary. Because in addition to what all I said, remember that 100,000 crores of tax giveaway has to flow through into the economy. Some of it will come into consumption, some of it will come to savings and investments. So I think BFSI and consumer discretionary both are the right spots as far as I'm concerned.
Great to have you on that note, Sunil, on the show. We'll let you go on that note. Thanks as always.